I was right about everything. I lost money. I want to describe the gap between those two statements because I think it is the most important thing I have learned in 20 years of short selling. My name is Victor Osei. I run credit research at an independent firm in London. We publish reports on companies we think are mispriced. Sometimes we short the stock, sometimes we don't. The decision depends on conviction and timing. In March 2018, I had both. On March 15, 2018, I shorted Vertex Capital Holdings plc. The position was £412,000. The mechanism was straightforward. Borrowed shares sold at $8,040 to be repurchased when the price collapsed. My research said 12 to 18 months. I sized the position for an 18-month window. The research was 40 pages. Report number VCH 2018-1. It identified 3 material concerns. First, 62% of the loan book was illiquid infrastructure debt. Second, stress testing excluded correlated asset price decline scenarios. Third, off-balance sheet vehicles added £140 million to effective leverage. The conclusion was a projected credit event within 12 to 18 months and a minimum 60% overvaluation. At month 20, I closed the position. I had lost £412,000. At month 29, Vertex Capital Holdings entered administration. The administration report was published 2 weeks later. 106 pages. I read it on a Tuesday morning. I made coffee. I sat at my desk. I opened the PDF. Page 7. Section titled Pre-Collapse Indicators. 3 material concerns listed. Concentration of illiquid infrastructure debt. Inadequate stress testing frameworks. Off-balance sheet exposures materially understating leverage. My 3 concerns. Word for word in 2 cases. Paraphrased in the 3rd. Footnote 12 at the bottom of the page. See VCH 2018-001. Osei Research, March 2018. I printed page 7. I still have it. I want to be precise about what happened. The research was correct. The timing model was wrong by 11 months. The position sizing was based on the timing model. The position expired before the collapse. 11 months early. If I had sized the position for 30 months instead of 18, I would have made approximately £2.4 million. But my model said 12 to 18 months. The model was right about the event, wrong about duration. I have thought about those 11 months many times. I have thought about whether the research matters if the position lost money, whether being cited on page 7 matters, whether the distinction between being right and winning exists anywhere except inside my own head. Most people assume being right and winning are the same thing. They are not the same thing. The gap between them is where I have lived since November 2020. The research took 3 months. I started in December 2017. Vertex had just released Q3 results. Loan book growth, 14% quarter on quarter. Share price, up 9%. The market liked the growth. I read the footnotes. Footnote 18, page 43. A table showing loan composition by asset class. 62% infrastructure, 31% commercial real estate, 7% other. Infrastructure debt is illiquid. If you need to sell fast, you cannot. If you need liquidity in a crisis, you do not have it. I called investor relations. I asked about stress testing. The IR officer said Vertex used a Monte Carlo simulation framework testing 10,000 scenarios. I asked if any scenarios included correlated asset price declines across infrastructure and commercial real estate simultaneously. She said she would get back to me. She did not get back to me. I filed a Freedom of Information request with the regulator. 6 weeks later, confirmation that Vertex's stress testing framework did not include correlated decline scenarios. Sectoral stress, yes. Macro stress, yes. Simultaneous sectoral correlation during macro stress, no. Translation. They tested what happens if infrastructure debt loses value. They tested what happens if commercial real estate loses value. They did not test what happens if both lose value at the same time during a recession. February 2018. I found the off-balance sheet vehicles. Annual report, page 91. 3 special purpose vehicles. Combined exposure, £140 million. Not consolidated, not stress tested. I wrote the report in March. 40 pages. Sent to clients March 14, 2018. Shorted the stock March 15th at $8.40 per share. Nothing happened. Share price down 2% the week after publication, then recovered. April, higher than March. June, 12% higher than March. The market did not care about my report. I held the position. Month 6, month 12, month 15. Share price stayed flat. The position was expensive to hold. Borrow costs, margin, opportunity cost. Month 18, I extended. Paid more. Month 20, I closed. £412,000. Gone. I want to describe what that felt like. It felt like the research did not matter. Like I had confused being correct with being useful. The market did not care if I was correct. The market cared about timing. I was wrong about timing. November 2019. I closed the position. I told myself, the research was good, but the trade was bad. Being right about analysis does not make you right about the position. You lost money because you were early, and early is the same as wrong. I believed that for 11 months. November 2020. Thursday. After market close. Vertex Capital Holdings announced it had entered administration. Share price suspended. The statement cited severe illiquidity in the loan book and material off-balance sheet exposures that crystallized during Q3 2020. I read it twice. I did not feel vindicated. I felt tired. 2 weeks later, the administration report. 106 pages. I have page 7 on my desk now. Next to it, the original 40-page report from March 2018. The relevant sentence from page 7 takes 8 seconds to read. The concentration of illiquid infrastructure debt, inadequate stress testing, and off-balance sheet exposures were identified as material risks in pre-collapse research. Notably, VCH 2018-001, Osei Research, March 2018, though no regulatory or market action was taken at that time. The conclusion of my 40-page report. Final paragraph. 30 seconds. Vertex Capital Holdings plc is overvalued by a minimum of 60%. Based on realistic stress scenarios that account for correlated asset price declines and off-balance sheet exposures. The loan book composition presents severe illiquid risk in any credit tightening environment. Stress testing frameworks are inadequate. We project a credit event within 12 to 18 months and rate Vertex a strong short. March 2018. Confirmed November 2020. Loss, £412,000. People ask if the loss still matters. It matters. Being right does not stop the loss mattering. Being cited on page 7 does not repay £412,000. Being correct about the research does not make the position profitable. The gap between those things is not poetic. It is not ironic. It is financial. I keep both reports on my desk because they describe the same event and opposite outcomes. January 2021. I received a call. Unfamiliar number. I answered. The voice. Mr. Osei, my name is Charles Pemberton. I'm the lead administrator on the Vertex Capital Holdings case. I did not say anything. He continued. I've read your report from March 2018. I wanted to call personally to tell you it's the most accurate pre-collapse analysis I've seen in 20 years of administration work. I said thank you. He said, I'm calling because we're handling several other cases with similar profiles. Infrastructure lenders, illiquid books. I'd like to know if you'd be willing to consult. We pay standard rates. You'd review loan books and stress assumptions. Pre-administration. I said yes. Since 21, I've worked on 4 administrations. I review loan books. I identify concentrations. I stress test the stress tests. I write reports. They pay me. Total consulting fees to date, £380,000. Loss on the Vertex short, £412,000, recovered through administration consulting generated by the Vertex short, £380,000. Net position down £32,000. I find that the most precise outcome I have ever experienced. The research was correct. The position lost money. The research generated work. The work nearly covered the loss. Not completely. £32,000 short. I have both reports on my desk now. 40 pages from March 2018. Administration report open. At page 7, I am going to file them. I keep them in a folder labeled Vertex 2018-2021. £32,000. That is what being right costs when you are paid to be right too early. I should say the folder has a second label. I added it in August 2022. Below Vertex 2018-2021 it says, Reference Behavioral Loop. I started using that term after the 3rd administration consultation. Behavioral loop. The pattern where being correct about a structural problem makes you the expert on that structural problem, which means you are consulted when the structural problem materializes, which compensates you for having been correct too early about the structural problem. It is not a strategy. You cannot design it. But once you recognize it, you begin to see it everywhere. In December 2022, I was invited to present at a closed forum organized by the Bank of England. 70 people, regulators, risk officers, 3 other short sellers. Topic: Early warning indicators in infrastructure lending. I spoke for 22 minutes. I used the Vertex structure as the primary case study. I described the loan book concentration, the SDLT dependency, the refinancing wall. I did not mention that I had shorted Vertex. I did not mention the loss. During questions, someone from the Prudential Regulation Authority asked, "How did you identify this exposure in 2018 when the company's disclosures were minimal?" I said, I visited the developments. I tracked planning applications. I cross-referenced lender behavior with SDLT regional data. He wrote that down. After the session, 3 people gave me business cards. One was from an asset manager with 4 billion under management. He asked if I did private consulting. I said yes. He said they were reviewing a portfolio of logistics warehouse conversions with similar leverage profiles. Would I review the loan book? Fee, £40,000 for 2 weeks of work. I accepted. The loan book was not identical to Vertex. The borrower was a different entity. The lenders were different. But the structure was nearly identical. High loan to value. Construction loans refinanced into long-term debt before completion. Revenue assumptions based on rental markets that were beginning to soften. I submitted my report in January 2023. 16 pages. I recommended they exit the position or demand additional collateral. They exited. 6 months later, the borrower entered administration. The asset manager sent me a brief email. It said, "Your work saved us £8 million. We will recommend you." They did recommend me. Since that referral, I have been retained 4 more times. Loan book reviews, stress assumption audits, all infrastructure or structured credit, all variations on the same structural pattern. Total additional consulting income from those engagements, £220,000. I have now made more money explaining what went wrong with Vertex than I lost shorting Vertex. Net position as of April 2024, up £188,000. I do not consider this winning. I will explain why. In March 2024, I received a call from a former colleague. He now runs a long-short credit fund, 200 million, institutional backing. He asked if I was still taking short positions. I said occasionally. He said, "We're looking at a UK house builder, similar profile to your Vertex work, loan concentration, overstated WI. We think it's a short. Would you review our thesis?" I agreed to review it on a consulting basis. He sent me the materials. I spent 4 days on the analysis. The thesis was sound. The company had the same structural indicators, high leverage, revenue dependent on a narrow regional market, loan book concentrated with 2 lenders who were themselves under capital pressure. I wrote my report, 8 pages. Conclusion: the thesis is correct. The company will face refinancing pressure within 18 months. If short interest increases, or if the lenders preemptively tighten terms, the timeline could compress to 12 months. I submitted the report. My colleague called the next day. He said, "This is excellent work, exactly what we needed. We're putting on the position next week." I have a second question. Would you be interested in taking the position with us? Direct participation. We'll allocate you up to 500,000 notional, same terms as the fund. I said I would think about it. That night, I opened the Vertex folder. I reread my original report from March 2018. Then I read the administration report. Then I reviewed the consulting invoices I had generated from the same analysis. I was trying to calculate something. Not financial, not precisely. I was trying to determine, if I participate in this short, and if the thesis is correct, and if the position still loses money due to timing, will I again be positioned to profit from the collapse I predicted by consulting on the collapse I predicted? And if the answer is yes, have I become someone who profits because their short positions fail? I did not take the position. I recommended to my colleague that he reduce the size by half and extend his timeline by 6 months. He thanked me. He said that was prudent. 3 months later, the house builder's share price dropped 18% after a lender demanded early repayment on a construction facility. My colleague's fund made money, not as much as they would have if they had sized it larger. But they made money. He called to thank me. He said, "You were right about the timeline. If we'd gone full size at the start, we'd have been stopped out. Your caution saved the trade." I did not tell him that my caution was not about the trade. It was about whether I wanted to become the kind of analyst who builds a business model on being correctly early, who earns credibility by losing money on predictions that later prove accurate, who gets paid twice, once in losses, once in consulting fees that arrive only because the losses established expertise. I think that is a real model. I think it works. I think some people do it intentionally. But I think it requires you to accept that losing money is part of your product. Not a failure, not a miscalculation, a feature. And I do not want to build a career where the optimal outcome is to be correct in a way that costs me money first and pays me later. I closed the Vertex folder in June 24. I have not opened it since. I still do consulting work. I still review loan books. But I have stopped taking short positions on infrastructure and structured credit. Not because I cannot identify the problems, because I can identify them too well. And I have learned that in certain markets, being able to identify a problem 18 months before it materializes is not an advantage. It is an expensive education that qualifies you to sell that education back to people who want to avoid paying for it themselves. I was asked last month to speak at another regulatory forum. Same topic, early warning indicators. They offered £5,000. I declined. The person organizing it asked why. I said I did not think I had anything new to add. She said, "But you're one of the few people who's been proven right about these structures. That's exactly the perspective we need." I did not say, "Yes, I was proven right. That is the problem." I said I was unavailable. The gap between being right and winning. I said at the start that I think it is the most important thing I have learned. I will refine that. The most important thing I have learned is not that there is a gap. Everyone knows there is a gap. The most important thing I have learned is that the gap itself can become profitable, and that once it becomes profitable, you are no longer trying to close it. You are managing it. I do not want to manage it. The Vertex folder is still on my desk. I am not going to file it. I am going to leave it there, labelled closed. £32,000, then £188,000, then a decision to stop. That is the full account.